Hey everybody. So in today's class, we're going to make an introduction into some of the functions that you might see if you go on to study economics, or anything like economics in the near future, accountancy, business, that kind of thing. So we spent a lot of time talking about models in our class, right? So we had the model of the circular flow of the economy. We had models of international trade. We had all those diagrams, which are models. And as far as you know right now, models look like pictures. Well, in reality, the models that are turned into pictures are like part of the output that generally reaches the public. But by and large, when we talk about models, we talk about models that look like equations, like this one. You can see in the link that I'll share with this video to some of the functions that we're going to examine this week. Now, they all follow this sort of format. This is trying to describe how U, the utility of something, depends upon T, the time, and say Y, the grade points. And it lets us, this is a person's utility function. It tells us that the person can spend time, and they can do that in aspiration of grades. So it treats the entire world as though there were only two issues to be decided upon: the use of one's free time and the aspiration for grade points. We do that, of course, because the models that we study, called stochastic models, are a reduction of reality. One of the most important models that you're going to learn about if you decide to study economics further is the Cobb-Douglas utility function. And it describes production of goods, and by and large the production of goods is dependent upon the things that you already know, right? So production depends upon labor and capital, and the important element is that in the Cobb-Douglas functions, each of the elements of our utility is affected by some form of technology, some kind of modifier. So if, by way of example, our free time comes with a really high technology multiplier, you are likely to make more use of free time than you would, say, of grades, right? If at the beginning of the year you knew that the exams at the end of the year were canceled, that would be a piece of technology, we'll call it technology, that would really make this value here, the y to the b, y to the beta, very, very small. Similarly, t to the power of alpha, or t alpha, is going to represent the value of your time. So now imagine some technology comes out, like it always seems to me that like the latest gaming system comes out right about the time you should be studying for your exams. So which is really irritating being a teacher. But if you see that the technology comes out, that technology, the way that you spend your free time, might really change the value of that time. That's the way this works. We're really modifying the value of those things that are part of whatever function it is you're studying. Now, you could read about the Cobb-Douglas function in the core econ text you see here. You could also read about it in Wikipedia. I'll just show you what that looks like. Here you go. Makes lots of pretty pictures. There it is in 3 dimensions. And it describes, just exactly like I was saying before, how production, or output, Y, is a function of labor and capital, and those are raised to technological components. So here we've got exponents, the exponent of beta and alpha. And depending upon the technologies that are available, labor can be very effective. Similarly, capital can be very effective with technologies. And so this makes a lot of sense. We had arrived at this function by examination of our environment. That's what stochastic means. It means looking at the world around us and making quantifiable observation from which we derive these equations. So Cobb and Douglas, Paul Douglas, and Charles Cobb did this back in in the 1930s and 40s. And this is really the start, I think, about how university economics is different. Instead of looking at the pictures and understanding how the pictures move, you look at functions, you look at equations like this, and think about what are the components and what do the components depend upon? How are they affected by change? If we were to try and build one of these, and I'll take the news story of today in economics. So the big news story of today is that West Texas Intermediate, which is a type of oil, have really changed in price. And why does that matter? Well, this is the WTI, the value of oil. You can sort of see it here in pink. And generally speaking, it's a little pessimistic about oil prices, but it follows very, very, very closely. It follows the Brent price. So we might say in our equation that WTI varies directly with the Brent oil price. Well, yeah, that's what we might say. Does that sound good? All right. So our if we had to build a function, we would say that the global oil price is a function of the price of WTI and the price of Brent. Yeah, right. Well, today you can sort of see here that the U.S. This is a shocking thing, by the way. The United States dollars per barrel has, for a long time, for a 20-year period, been around about $20 a barrel. Then after the turn of the millennia, the year 2000, we saw the oil price increase all the way up to this event right here, which is 2008. Right now, in 2008, we saw the oil price precipitously drop, but that's for both of those markets, and obviously that's because of the financial crisis. But still, even at its low point in the financial crisis, we're still looking at a dollar value of $40 a barrel, from where after the interventions by government raised the prices to a very extreme level. Brent, just as an FYI, is the oil price value that we use in Britain. West Texas is an American measure, and it's used for landlocked oil supplies. So here you see Britain's response to the crisis appeared to drive demand more than the American response to the 2008 financial crisis. But not a lot in it. By the time we get to this next crisis here, late in 2014, there was an oil crisis, not related to a particular financial crisis. But again, even in this period, we're seeing oil prices of like $40, $50 a barrel. Okay, swell. So that's what we've seen. Why is this important? Well, this is important because if we wanted to build a model of the global economy, somewhere in the model of the global economy would feature the oil price, right? It's a good that's used in production of many other goods. It's a derived demand good. It is widely consumed by all nations. And what happened today? So today, you're looking at this graph. Today, this happened here. So we went from a $50, $60 barrel here like this. And today, the price of West Texas Intermediate fell to, well, I'm going to zoom in on this. It says on this diagram that it fell to $18.27. Yeah, right. Well, that is true. It did fall to $18.27. It lost 99% of its value in an extremely short period of time. And the reason that that is concerning is not that it lost its value today, but something that's not going to show up on this diagram, but will be all over the internet if you take a look. Let me just see if I can find it. It's that the prediction, no, it's not going to be there. The predicted future value for oil fell to negative today, which I don't fully understand what that means, actually. Because how could something be worth less than nothing? But the bottom line is that there was an even further crash than what you see in the diagram in aftermarket trading, and the price per barrel is now $11 US. I want you to think about that. 11 US dollars is like, it's the better part of like £7. So for £7, you could buy an entire barrel of oil. I think that is remarkable. And it means a lot, not for, I mean, obviously it means a lot to people who are investors. It means an awful lot to the oil companies. It means a lot to production. But in our Cobb-Douglas function, all of a sudden, one of the key inputs to the productive process has become ludicrously cheap. And what is that going to mean for our productive capacity? Well, this is quite, I think, a fascinating thing to think about. On the one hand, we've got the COVID crisis, which has absolutely stemmed demand, right? There's just people have just completely soaked up their interest in spending at the moment. But on the other hand, right now, if you wanted to produce a bunch of goods, gosh, the inputs to those goods are cheap. I wonder if this is going to mitigate, if it's going to stop the crisis of COVID being as full-blown as it otherwise would. So anyway, that's what I wanted to show you. I wanted to show you how the models are built up. I wanted to introduce this thing called the Cobb-Douglas function. You could read about it further on YouTube. You could read about it further here in the core econ. Like I say, I will share this link with you. And don't get put off by the mathematics. It does get weird. There's symbols you don't understand, but try and see through that if you decide to read this version of the text. Every day this week, I'll show you a different function, and we'll get you used to the idea of seeing the letters in the format that they're represented in here. Great, super. Look forward to talking about this further. If you fancy reading about the oil crisis of today, by the way, by all means. Great. Ciao.